So it seems to me like we just had the shortest recession ever. At least
Recession? Which recession? No, seriously.
It's crazy though. I mean, I can't even remember, a year ago we weren't writing any funding stories. Now it's every day.
So just a perspective. October 2008, end of good times, Sequoia presentation,
Right.
it's all bad. Q4 2008, companies sort of chop 10 to 20% of their costs. People get laid off and so on and so forth, unfortunately, so that they can actually extend their runway. Q1, Q2, 09, sort of challenging. Advertising revenue goes down, spending online sort of goes down. People sort of feel that they are cash-strapped, but innovation still continues, and there's a ton of interesting deals sort of coming up. Most of them being actually businesses. So people saying, okay, fine, I understand that to get my startup off the ground, I need to demonstrate that there is value, that I have potential customers, and that it will actually pay for something.
So there was a little bit of a higher bar, even if it was self-instituted.
Yes. And so as investors, there is a rule which is you never get out of the market. You never try and time your investment. You never invest in good times and stop investing in bad times, because by definition, a lot of interesting companies, and you guys wrote about that at that time, a lot of companies have been sort of created in counter-cyclical
down market,
down markets.
And you sped up your investments in the last couple of years, given that you had a fund.
And I just saw this sort of constant flow of interesting opportunities, and if I feel that it's an interesting opportunity, I will essentially invest. And so in 2009, if I look at the vintage, I ended up doing 14 new investments, which is pretty active. I ended up selling 3 companies. I also had, out of the fund, I had a personal exit, Mint, which was nice. I did 3 follow-ons, and I just sourced a ton of interesting deals. So,
what were the other ones that sold last year?
So the 3 were Dance Jam, Olo, and Mixer Labs to Twitter. So I'm now an investor in Twitter.
Right. At the end of last year.
At the end of last year for the Geo API. It's a really interesting infrastructure. And so if you consider a recession as an environment where everything stops and there's sort of no activity in terms of funding, no activity in terms of M&A, no activity in terms of, God forbid, IPOs, 2009 ended up as a great year.
We haven't had IPOs since you started investing.
Well, we've had, right? If you look at
Have you?
Oh, no, I haven't had, no IPOs. Only I've had $300 million worth of trade sales, but no IPOs. Yet.
Okay, yet. All right. Okay, we were talking about the recession, so now we're not in a recession, it's clear.
We're no longer in a recession, it's been the shortest recession ever. Right?
Tell us about how frothy it is right now.
So the frothiness of the market, how do we sort of try and establish that? At 2 levels. One is, what is the average valuation at which the rounds get done early, so the seed rounds or sort of the early stage rounds, as we call them, the first $500,000 million that I typically
That's
am
when
part
you get
of.
involved.
That's when I get involved. And how competitive are the rounds that follow that initial round, which would be sort of the Series A, Series B, however you call it, which is the $5 to $7 million round that will typically get the company to another level of scale. And I can tell you that...
And you usually participate in the Series A?
No, because, well, I will do selectively, but because of the size of my fund, 15, my average investment is 100 to 500, typically in the 200 to 50 range. And for me, being part of a $5 million round means that the amount of ownership I would get at that time doesn't really sort of make sense.
Yeah.
So what I've seen, I would say starting September of last year, is those Series Bs, those sort of $3 to $5 million rounds, to become very competitive, where in my portfolio, one of 2 things happened. Either the companies got multiple term sheets with upticks in valuation just to be able to capture the deal from great firms, or a lot of those deals got preempted. The preemption means a company is sort of in between funding rounds, and not looking for money, but someone sort of comes down and drops a term sheet, like literally drops a term sheet in front of the team saying, in order for me to capture that deal, to buy access, I'm ready to offer those terms right now. And typically, they will sort of pay up a valuation which is almost the valuation that the company would be worth maybe 6 months later. At
So
that
a nice
time.
premium.
So sort of nice. It's sort of a no-brainer. So
Yeah.
the way
So
to
do your
think about
companies usually take that?
if it's interesting enough, sure.
Yeah.
Because it's very distracting for a company to actually raise money, and so
Right.
if they get
you don't have to do any work.
you always have to do work, but a bit of work. If you can get great terms from great investors,
Yeah.
it sort of makes sense.
What about the competition at your level when you're trying to get in an angel round? I mean, is it pretty easy for you to get in? And also, have you seen a change in the amount of those rounds? It seems like they're higher and higher, closer and closer to $1 million now, at least.
If it was closer to $1 million, I wouldn't be worried. I've actually seen quite a few of those pseudo seed rounds being like 2 million, 2.5, which is basically a Series A. And so, the seed is a new Series A kind of thing. So there's really three aspects. One is competition. Typically, the early stage isn't competitive per se. There is like a bit of friction sometimes. You can't get everyone in because there is actually a lot of people trying to get in those deals. So it used to be maybe 2 years ago where we could sort of cut back a little bit and get a bunch of the good guys, the good investors in the company sort of in, and everyone would watch it back. That's no longer really possible because there's just too much money around. If you're sort of establish your brand or whatever, people might try to sort of get you in if you're interested, but they will sort of also cut you back a little bit. So your ability to capture a large portion of that funding round is now more limited than it used to be. The companies are raising more, so I would say that $500,000, $750,000 used to be sort of your standard seed deal. Now we're getting closer to $1 million, $1.2 million, $1.5 million. And the rounds creep up in size because of the interest. So you start with, okay, I'm going to raise 750, and you end up with $1.2 million, just because somewhere along the way, a bunch of people heard about the deal and said, I want in, I want in, I want in.
Does this make you worried?
I'm worried about the companies which raise money on too high valuation, because at the end of the day, there is just a standard, if you want, set of terms and valuations that you want to sort of fit in, to not, it's great to raise money at a great valuation.
Right.
That's clear, but you
then
have to
the
be
bigger you are, the bigger you fail.
you have to sort of grow into it and make sure that if you're on a super high growth trajectory, the next round is sort of compatible with whatever valuation you get. And if people are sort of comfortable to offer you, double the valuation that you would be otherwise, command in a standard market, good for you, but make sure that there isn't a downside risk on that, and make sure you don't raise too much money, because if you raising too much money is actually a risk for a startup. You want to raise the right amount of money, because when you raise money, you actually spend it. It's crazy, but it's true. And so the other is, at the end of the day, the market can sustain 1 or 2 or 3 competitors in a given market, not 20.
Yeah.
And if you see too many knockoffs or too many lookalikes being funded, that's an issue because it creates a dilution in the market, creates noise. Fundamentally, the number one risk we have today in this environment is hiring. It's finding talent is extremely hard. Finding good developers
Probably
is
this year
hard.
more so than last year.
Absolutely. And because you have, companies like Twitter, like Facebook that definitely hire by the boatload and they hire really good talent, and startups actually try and do the same thing. And the problem is that we don't print engineers, right? We don't sort of grow them. We actually have to sort of find them somewhere. And people have to become like extremely innovative in the way they're going to try and recruit and hire that talent. I'm concerned about the dilution of talent that we see because too many companies, I'm not saying too many, but because a lot of companies get funded on premises which, sometimes I'm just questioning.
Yeah, well, it might be the shortest boom ever after the shortest recession ever then.
Well, we'll see.
We'll have to see.
I just hope, fundamentally there's a lot of good things happening right now in the market where a lot of the building blocks of commerce and local and everything that it's taken years to get there is finally sort of getting into place. And so I hope that we don't boom too much.
Okay. I have a few kind of generic investor questions that we could do a little
Go for
rapid
it.
fire. So, what are 2 or 3 companies you've invested in that we should go check out?
Plancast, Fresh Planet, and the third, retail.
Okay. What's a recent investment that you or a recent company that you wish you had invested in?
Foursquare. I
Okay.
passed in June, July, and that was a mistake.
Yeah. And what are the emerging markets that you're most excited about?
I think that the whole sort of iPad as a platform is going to open a lot of opportunities in terms of new computing sort of paradigm. I think it's much more than just an in-between, the computer and the phone sort of device. So I think there's going to be value created there, and I'm looking at a few companies that are building sort of interesting things. The whole geolocation clearly is exploding. It's not so much a question of how Foursquare and Gowalla sort of grow, but it's just the infrastructure which is being built.
Right. But do you really want to be at the seed stage of a location company now when it's already so hyped?
Well, so I guess the question is,
Are
are
there
you looking at the
new
trends, or are you looking at what I'm actually looking at investing in?
Well, I'm saying what's next, and that seems like
Okay, what's
location is
next?
already fully here, at least in terms
No.
of excitement.
I think
No, you
the
think there's
excitement is here, but I think that there's still sort of quite a bit of
work to be done.
work to be done in terms of infrastructure, in terms of there's a lot of things which still need to be sort of geo-enabled.
Sure.
And so it's like one of the angles, one of the components that each and every business now, each and every application, each and every business will consider adding. The same way that social was,
Right.
if you're not social as an application 2 years ago, you were like, which
Right.
century?
You need that layer.
You need that layer. So, and as you sort of have this ground availability of geolocation information across multiple types of applications, then, and that sort of leads me to my next trend, which is sort of big data. And big data is we just capture, we just generate, we just have tons of data points across services, metrics, and so on and so forth that we don't really know how to handle. And
Yeah.
there will be sort of opportunities.
That's the sign
to,
of an emerging trend, right? When you can use a word and everyone loves it, but they don't know exactly what it
Yeah.
means.
And so I'm starting to look at some of those opportunities, not clear exactly what form or shape that's gonna take, but there is actually a lot of companies trying to offer their own service or implementation, whether it's the storage level, whether it's the analysis level, whether it's manipulation. There are things which are happening there which are interesting.
Great. Well, we look forward to hearing about them once you do
You will on
invest.
Twitter?
All right. Thanks a lot, Jeff.
Thank you, Liz.